it's a tough quarter for everyone. CapEx cuts front and center. Where are you cutting?
Well, Alex, first of all, I'd just like to say our thoughts remain with the victims of COVID-19 and also with all the workers out there on the front line in the health industry and in our company and many others that are keeping the basic goods and services moving that everybody relies on. Our first quarter was a solid quarter, and I think the results reflect that. Second quarter certainly is a little bit tougher. We're in a different position than some of the others in our industry. We were prepared to execute. Our financial priorities are unchanged, and the dividend is secure. We know what to do, and we're doing it, and that includes making prudent adjustments to our capital spending, our operating expense, and the things necessary in an environment where demand has contracted. Prices reflect that, and we intend to continue to make the right moves as we go through this very challenging quarter that we're in.
So where are you cutting?
It's in our flexible short cycle activity, so that would include unconventionals here in the United States and elsewhere in our portfolio. We've got some other projects where we can slow down activity and focus on critical path and reduce spend on some things that are not on the critical path. So there are reductions across our portfolio, but the primary area would be in the shale and tight, including in the Permian Basin.
So can you give me some visibility then on how quickly you'll reduce rigs and production there, and then what that does to your underlying production base?
Sure. We began the year with 17 rigs running in the Permian. We're down to 5 right now, and
wow.
And so production tends to lag rig activity, and so what we're seeing is production actually reflects wells that came on in the last half of 2019, the first quarter of this year, and as you know, these wells have strong early production. So our production actually is a little disconnected from the rig decline. Production at this point still is on an upward trend. What we've indicated is over the course of this year, we would expect to exit the year at about the level that we entered. So we'll see production higher than that through the middle part of the year, but we'll end the year about flat with how we entered and on a downward slope with this level of activity.
Right, I was going to say, so does that mean that we can expect then lower Permian production in 2021? It seems like that's what you're saying, is you're going to really feel the effects of this CapEx cut?
I think you could expect that, and certainly the other thing that we will be talking to investors about today is the fact that there will be other reductions in production, flowing production. So not just impacts of our capital changes, but certainly in this market, we operate in some countries that are subject to the OPEC agreement, and so there are likely to be some production curtailments there. And then for logistics and economic reasons in other parts of our portfolio, we're also likely to curtail production. So we'll see production here in the month of May down probably 200 to 300,000 barrels of oil equivalent per day, and June, same range or perhaps even a little bit greater than that.
I'm glad you brought up the OPEC plus cuts and the logistics. Do you have a sense of how you're going to allocate your CapEx cuts, like those areas for logistics, those areas for OPEC plus versus your own choice, like say what you're talking about in the Permian?
Certainly our capital reductions are driven by our own views on where the opportunities are. We've got a lot of short cycle capital in our budget. That's one of our advantages. I mentioned we're different. We came into this with the strongest balance sheet in the industry, a very low break even, and a very flexible capital budget. So we're in control of those choices, and the market signal right now isn't calling for more near-term production. So that's why it makes sense to reduce capital in the short cycle part of our portfolio, and we're in control of that. The OPEC actions really affect flowing barrels as opposed to the investment of capital to produce barrels into the future. So and as I said, we'll reduce that primarily in our short cycle activity.
For that production, both for the flowing production and then the short cycle, how quickly can that come back, or is any of that, do you anticipate, permanent?
Well, it can come back relatively quickly. These are these are things that we actually do for maintenance purposes. We bring wells down and facilities down for storms, hurricanes, things like that. So our people are very good at bringing production down safely and then ramping it back up. So we'll come back up in a matter of weeks when we start to see the market signals that would suggest it. And this can be done in a way that is very careful and doesn't cause damage to wells or reservoirs.
So let's get to your balance sheet. You have the least debt among all the majors. You've been talking about how that puts you in a different spot coming in. Shell really surprised everybody by cutting their dividend and not offering like a scrip dividend instead. If this goes on for a while, would you ever consider borrowing to pay your dividend?
Well, we're in a position right now where we did come in with the strongest balance sheet, and we've been setting the company up to compete in any kind of an environment. While we didn't expect this exact circumstance, we were prepared for it with a strong balance sheet, a low break-even, and a flexible capital program. As we go through a period of these extremely low prices, our costs and spending don't reset as fast as revenues do, and that's why you have a strong balance sheet. And we have plenty of capacity to endure low prices for quite some time. And I said earlier, our financial priorities are unchanged. The dividend has always been our top priority, followed by investing to grow the business to support that dividend and maintaining a strong balance sheet. So that framework is serving us very well in a time like this. And our dividend is safe, and we're prepared to support the dividend through the balance sheet and through these other moves that I've talked about, reducing the share repurchase program, $5 billion a year, $6 billion in capital reductions, $1 billion in OPEX this year, and another $1 billion in OPEX next year. And we've closed almost $2 billion in asset sales already this year. So we are preserving cash to keep the balance sheet strong so we can rely on it as we move through this period of time.
So, okay, can I infer that you don't foresee a time when you'd have to take on debt to pay your dividend?
Well, I said we'll rely on we're keeping the balance sheet strong. We will rely on the balance sheet and take on debt to support our overall cash needs, which include our capital program and the dividend. Through a period of time like this, nobody in the industry is set up to cover that just out of cash flow. That's why in a commodity business you maintain a strong financial position, a conservative posture. Capital always matters. Cost always matters, and your balance sheet is a tremendous asset that you really need. And when times like this arrive, you use the balance sheet to meet all those demands, maintain your priorities through the cycle, and that's certainly what our plan is.
Do you feel like we're ever going to see a real recovery in U.S. shale? Or is this really an historic collapse of that entire industry that will then be left to the, large E&Ps and the majors like yourself?
Well, I think we'll see a recovery, certainly. The hydrocarbons are still there in the rocks. It's a tremendous resource for our country and our economy. And we've seen that it has underpinned a good part of economic growth in this country over the last decade. It's got strong trade and geopolitical benefits to our country, and it's a great asset and a great resource. Exactly how it comes back and when it comes back is a function of how the health situation plays out, how the economy resumes in this country and around the world, and then how oil markets respond. And I think oil markets will be well supplied as we come out of this. And so the price signal will be modest as we go through a recovery. But we've found ways to make the Permian Basin highly competitive. It's attractive and even at low prices can carry positive economics with it. And so I think the fundamental equation there is strong. How it's developed, how companies may restructure themselves to do that even more efficiently, I think remains to be seen.
So do you expect then, just based on what you said, do you expect a supply shock coming down? I feel like there's two schools of thought. One is that this will sort of accelerate the peak oil demand story, and then the other is that we're going to see a really tight market somewhere in 2021, 2022 because of all the big cuts that are happening now. What's your best read?
Well, it's really difficult when you're in the kind of in the bottom of this to know for certain how that will play out. And I think there's an undeniable link between how effectively the globe deals with the pandemic and is able to resume economic activity, and how these markets will play out. And so in a case where we have really good progress and we see the virus stay under control and economies heal in a relatively consistent and positive manner, this overhang of inventory will work its way down, and you'll see markets return to a circumstance similar to pre-crisis more quickly. If it's a choppier path, if we have implications of a second wave of the virus that require governments to reinstitute some of these policies, then we could see these large inventory levels persist for a longer period of time. The cuts in OPEC and other countries are certainly another source of ready supply to come back into the market. And so I don't think we should expect a supply-constrained world here in the next couple of years. We're going to have oil in storage. We're going to have cuts in countries that would like to come back into the market quickly. And so I think there will be readily available supply to meet demand as it resumes its growth out of this.
Mike, last question. It's not actually an M&A question, so you can be happy about that one. The last question is, what do you think about the government potentially providing support for smaller E&P companies to stay afloat?
Well, in general, we believe in markets, and we believe in markets in good times. We believe in markets in difficult times, and yet this is an extraordinary time. So certainly the government has taken actions to ensure liquidity in markets so that people have access to funds. I think every company is in a different situation, and I think companies that have been well managed and prudent and find themselves in a position where they're in a short-term squeeze, programs to help them out could make sense. In general, we're not in favor of targeted actions and bailouts for our industry. And certainly, we think there needs to be some prudence as companies that have not positioned themselves in a way that would be prudent coming into a tough market. A bailout kind of reinforces, the moral hazard argument. And so I think anything should be measured. It should ensure the taxpayers are properly compensated for the use of the tax dollars, and should be pretty limited in application and duration to really help through the most difficult times. But look, we think markets should work. We're not in favor of bailouts, and markets competition and the strength of our industry is a function of innovation, of meeting the challenge of global competition, and kind of the creative destruction that goes along with that as we all learn and improve and innovate. And so we think that's the real source of long-term value in our industry, and I think market cycles are part of our industry. They always have been, and we don't need the government to come in and protect us from a part of our industry that we know and we should prepare for.